should. So, as usual, this is a joint production. This cee.swiss Impulse session is a joint production between 30 now Swiss bilateral chambers of commerce in the Central Eastern European region. With all of them, we have a very close and good collaboration, and many of those are actually, and now I need to change that very quickly here to English. All right, I felt I have to do that. So, and the newest one actually is the Swiss Montenegrin Chamber of Commerce that was just founded a couple of months ago. So welcome also to our colleagues from Montenegro, and we look forward to a great collaboration. Now, because we talk a little bit about economy today, I just wanted to also shed a bit of light from my side regarding what we have seen in terms of let's say, trade and economic development between Switzerland and the 17 countries of Central Eastern Europe. And as you can see now, we look here at the chart where you see import and export growth from those countries to Switzerland. We have almost, or we can say we have more than tripled trade and imports from the region to Switzerland. And to put that in comparison, I personally don't know any other major region that has seen so much growth. And if you break it down a little bit to, if you are from the region to your countries, now these are, and sorry, it's in German actually, I just see that. But anyway, you can assume which country it means. But these are the import numbers, meaning your export numbers to Switzerland. And also here, the Swiss exports to your countries with Poland and Czechia as the #1 countries. Now, unfortunately, last year was not a super year. I saw just recently the machine export numbers to Central Eastern Europe, but they were still better than to the most other countries in the world, and mostly also much better to Western Europe. So this relationship, and this is what I wanted to underline, to the 17 Central Eastern European countries makes a lot of sense from an economic perspective, but it also makes a lot of sense from a societal perspective, because with more than 1 million people from the diaspora living in Switzerland, we have an exceptional high amount of exchange between the countries, between Switzerland and the 17 countries. And this has actually led, and let me just do, because it's the first one of this year, show one slide, really, really positive development of our Swiss Chamber of Commerce for Central Eastern Europe, where I have the pleasure of running it, where we have seen over 120% of growth in the last 3 years. And this is testimony of the importance of the relationship between the countries. And I invite you, if you want to join this, more and more becoming more important exchange between the countries, please check out what the chambers of commerce are doing in your country, and also what we are doing with SEC, our chamber. We really invite you to join our activities, because only if we grow, if we have more people involved, we can do more for the region. Okay, so that's it. Little introduction also from my side. Now coming to the webinar today. It's as usual about a 30-25-minute keynote speech by Martin. You are on mute and you have no video, so we won't hear you. We try to end on time, which means 11:45. If you have anything to say hello now using the chat function. Tell us where you're from, what company you're working, maybe if you have a question. Now, if you have a question, please use the Q&A button at the bottom to ask question. At the end, you will receive all slides and the contact details of the speakers and of the Chamber of Commerce, and you can rewatch the session on our YouTube channel. Now, the next cee.swiss Impulse session, we don't have the dates yet. As usual, we also invite you, if you have any idea what you would like to have a session on, please write us at info@cee.swiss. We will have a session on quantum computing, a fascinating topic, and one will be on the future of mobility. We will inform you about the dates. And now, with no further ado, let me introduce you to Martin Weder. Martin Weder is Chief Economist and Head of Economic Research at ZKB. Now, ZKB is the Zurich Cantonal Bank, which is most of Swiss cantons actually have a bank which belongs to the canton, but this is not a normal cantonal bank because it's the second largest bank in Switzerland overall. Martin, you tell me if I'm wrong. But I think now with UBS and Credit Suisse having merged, I think ZKB is the second largest. And Martin now is an important part of ZKB's CIO office. His team is responsible for analyzing and forecasting macroeconomic, monetary policy, and geopolitical developments. Before joining ZKB in 2018 as senior economist for Europe, he worked at the Swiss National Bank in the area of financial market analysis and as research associate at Economist Swiss, the Swiss Business Federation. He holds a PhD in political economy from the University of Lucerne and an MA in economics from the University of St. Gallen and Sophia University in Tokyo, Japan. Martin, the floor is yours.
Thank you very much, Oliver, for this kind introduction. I hope you can all hear me. I'm excited to be back here with this webinar. I was invited last year to present a global economic and financial outlook, and I was invited again this year. And I'm particularly excited because the numbers that Oliver just presented are really impressive. So it's exciting for me to be part of such a dynamic chamber of commerce with so many members and a growing member base. So thank you for having me. Let's start with the outline for my presentation. I will try to present 4 different parts. The first one is just a general global economic and financial outlook, a very general overview, but also with a focus, of course, on Central and Eastern Europe. And then a larger part will be on Trump 2.0. What does the new or old US president mean for Central and Eastern Europe? What's in store in terms of trade conflicts, security concerns, issues, military aid, and whatnot. Then I will also focus on Europe, where I will argue that Europe is better than its reputation. Its reputation seems to be rather poor. There's a lot of talk about crisis and political instability, stagnation, and whatnot. But I'll try to argue that things are a lot better than what you can read and see from the media every day. And then finally, I will also present a few things on geopolitics and whether we are facing a new Cold War or possibly whether we are already part of a new Cold War. And then, of course, I'm also looking forward for your comments and questions. I know last year there were a lot of great and also critical comments and questions, so I'm looking forward to those from you. So let's start with the economic and financial outlook. Just like last year, I'll start with our growth projections, starting with the advanced Western economies. And here the general picture is that global growth is not impressive. It wasn't impressive last year, and it's unlikely to be impressive this year and next. So we are assuming a global growth of a little below 3%, which is below the historical average. But when we look below the surface, we see there's one reason for this not very impressive growth is, of course, both the cyclical and the structural slowdown in China. And we're also expecting a slowdown in the US from rather high levels. So the US economy was growing at around 3% for a while now, which we think is unsustainable, because we still have a slowdown on the labor market. We think consumption spending is unlikely to continue at this rapid pace. So we're expecting a slowdown there. So the 2 largest economies are likely to slow down. But the positive news is that, on the other hand, we have an acceleration, a gradual recovery, basically in the rest of the world. So this includes the Eurozone, Canada, UK, Australia. You see here the growth numbers that we have in place, but it also includes Latin America, Asia, and also obviously Central and Eastern Europe. What's the reason for this optimism? So it's not going to be impressive, but it's going to be rather robust growth, and it's also broad-based. So more and more countries recovering, while the two largest ones are slowing down. So there's lots of reason for this cautious optimism. One is that the leading economic indicators, at least at the global level, are still pointing in the right direction. You see here the blue line, the OECD composite leading indicator, still pointing upwards and is above the red line, which is the long-term average. And the PMIs, or the purchasing manager indices, showing a little bit more a mixed picture, but also more or less in line with the historical average. So our forecasts are actually below what the indicators are currently pointing to. The other reason for cautious optimism you see on the right-hand side is inflation. So there's still a lot of talk about inflation, but not as much as in 2022 or 2023. And also central banks have started to cut interest rates. The most recent surveys among firms show a slight uptick here on the right-hand side in terms of input and output prices. Part of that is due to energy prices, especially in Europe. And the other part is driven by the US because of expectations of incoming tariffs. And indeed, we've already seen quite a large number of announcements or threats by President Trump. And so this is what firms anticipate, that more is in store in terms of tariffs, and firms are likely to put those tariffs on consumers. So consumer prices are expected to rise, especially in the US, if Trump really follows through with what he has indicated and announced so far. But I will return to that topic of trade conflicts in just a moment. So when it comes to Central and Eastern Europe, the picture hasn't really changed all that much from last year's forecast. We had the same chart here, the left one, about economic sentiment, which is published monthly by the European Commission. And we actually see that we are slightly below the level where we were a year ago. So economic sentiment is a little bit below the long-term average. And you also see there's quite a lot of differences within Central and Eastern European countries. What also hasn't changed, Bulgaria is still on top. So sentiment in Bulgaria is higher than in other Central and Eastern European countries, but also the economy obviously is doing quite well. And at the bottom, we still have Estonia, which has been in an difficult economic situation for quite a while now, so where sentiment is still quite low. With that, you see in comparison the Eurozone on the right-hand side, quite a similar picture, and you see that the economic sentiment is actually a very good indicator or early leading indicator for real GDP growth. And here in the Euro area, sentiment is also below the long-term average, around 95. So 100 is the long-term average, and which points to real GDP growth of around 1% for this year. And this is pretty much also our forecast for the Eurozone for this year. So a little bit more than what we had last year, but just a very gradual and also bumpy road to recovery. So when you come to a real GDP forecast for Central and Eastern Europe, you see here the same story that I mentioned previously, accelerating growth rates, but from a rather low level. In the case of Estonia, even from negative rates. So at least the trend seems to be going in the right direction. But what you don't see on this chart is what we had in 2024 compared to what we and also others were expecting for 2024. And here we must say that in most cases, growth came in lower than expected. We had some countries such as Poland, Slovakia, Lithuania, and also Bulgaria, where growth was more or less in line with forecasts, in some cases even above. But for most other countries here on this chart, we actually had disappointments in terms of real GDP growth. So we are starting from a lower base than we were expecting around a year ago. But the positive story here again is also about inflation, even in Central and Eastern European countries. Inflation has come down further last year, but we also always mentioned that the last mile is the most difficult one in terms of reestablishing price stability. And this is also the case in this current cycle. So it's getting more and more difficult to make further progress. And one reason for that, and I will come back to this topic, is the still strong labor market and high wage growth. And with high wage growth, we still have considerable price pressure, especially in the services sector. On the right-hand side, you see progress is also stalling in Central and Eastern Europe, especially Romania, still above 5% inflation. But nonetheless, we've seen some interest rate cuts last year, but we're expecting a slowdown of those rate cuts now in 2025. And you see the reason why here with our inflation forecasts. As I said, this is the positive story. Also, when we look back to 2024, some disappointing news in terms of growth, but more encouraging or even positive news in terms of inflation. And also here the trend is going in the right direction with price pressure moderating in most countries, but still elevated in some cases. So yeah, it takes a little while to get back to 2% or being close to 2%. But we're getting there slowly but steadily. That's the upshot. So let's turn to Trump 2.0. As you've probably all seen, a lot of executive orders from day one, basically doing what he already announced or predicted during election campaign. So predictably unpredictable, I would say, for Trump. He continues where he left during his first term. And yeah, I will turn now to the question, what does it mean for the world and especially for Central and Eastern Europe? And here I had an interesting index that was compiled by the Economist intelligence unit. They have an army of very smart economists who compile all kinds of data, and they aggregated those data to find out which countries are particularly exposed to any policy changes expected under a Trump administration. And by policy changes, they focused on three main topics. The first one, obviously, is tariffs and trade restrictions in general. Which carries a 40% weight in their analysis. And then also 40% weight is security burden sharing, military aid, key defense relationships, etc. Obviously, NATO contributions here is an important topic. And then the third factor that they also analyzed was tighter border and security controls, which by definition affects primarily the neighboring countries, Mexico and Canada, and then also Central and to some degree Southern American countries. And the result is presented here in terms of colors. So the orange, yellow, orange, red means countries are particularly exposed or vulnerable to Trump 2.0. And you can see they're primarily based in North and Central America. Germany also sticks out within Europe, in contrast to Poland, for example, which doesn't seem to be exposed. And then also we have some Asian countries, particularly China, of course, in terms of trade and also security concerns, but also Japan and Vietnam in terms of trade exposure to the US. When we go into the details in those three parts, trade, security, and immigration, you see here the top 10 countries. And you have Germany in there, but with the exception of Germany, there are no European countries in there. So obviously Germany is particularly exposed, not only because of trade, but also because of NATO contributions and other reasons. But it's primarily a thing about Mexico, Canada we've seen, but it's not on this list, so perhaps surprisingly. But then also, as I mentioned, many Central and Southern American countries. And we've seen some of that already during the first few weeks of Trump. I would say Canada is perhaps the biggest surprise among the top two trade partners, but already we've seen this threat of 25% tariffs that have now been put off at least for a month. And also have to say that we don't think that Trump will actually follow through with high tariffs against Mexico and Canada. We think this is more like a negotiation or pressure tool to get deals done. This is the famous book by Trump, The Art of the Deal, and we think that's what he wants to do, to finish great deals that benefit America or that make America great again, as he calls it. But we think that blanket tariffs on Mexico and Canada, the two most important trading partners, will be really shooting themselves in their own foot. I mean, depend a lot on energy from Canada. They depend a lot on manufacturing parts, especially cars and car parts from Mexico. So this would directly feed through inflation and U.S. consumers if the U.S. would really follow through with high tariffs. And they also have a free trade agreement, which is kind of ironic. The USMCA, which actually was agreed under Trump, under the first Trump presidency. So it's kind of crazy that he now starts a trade conflict with his two most important partners and neighboring countries. So you've seen articles like with friends like these, who needs any enemies? So I think this is really a little bit irritating that he's now starting this trade conflict with Mexico and Canada. But you can argue the good news is Europe doesn't seem to be in focus, at least so far. I think this will change quite soon. Trump has also hinted as much. And yeah, he always focuses on trade deficits because he has this strange view, which is completely in contrast with what basically all economists think, namely that trade is beneficial for both partners or both countries. But Trump has this zero-sum view. So countries with a trade surplus are evil. They try to take advantage of the US. Countries with a deficit, that's fine. But as you probably know, most countries have a trade surplus against the US. And you see here the top 15. Here again, the good news is with the exception maybe of Ireland and Germany, but these are Western Europe economies. No one seems to be particularly exposed. This is again China, Mexico, Vietnam. Canada is actually quite further down. And then maybe also Switzerland, perhaps surprisingly, as a rather small country. And there's some data on Central and Eastern Europe countries from the US data. You see Hungary, Czechia, and Poland, but actually quite a small surplus, which of course also has to do with the relative size of these economies against other countries. But again, the focus seems to be on other countries, and I think this will likely to remain the case during his entire presidency. So I think some reason for cautious optimism in terms of Europe and especially Central and Eastern Europe. There's this threat that Trump announced during the election campaign of blanket US import tariffs of 10 to 20%. So basically all US imports, all countries, all products covered by a universal tariff of 10 to 20%. I don't think this will happen. I think this is, again, a threat and will probably likely be watered down, postponed, phased in over several months, if not quarters, if it happens at all. But you see, again, the most exposed countries are obviously Mexico and Canada, where about 80% of exports go to the US. So this is by far the most important trading partner. Here the measure is in terms of in percent of GDP. And you see the larger or more exposed countries on the left-hand side, and then by comparison, the more Western Europe and Central and Eastern Europe countries compared to those countries and using the same scale. And you see like 3 countries sticking out, Slovakia, even a little bit more exposed than Switzerland, at least in terms of GDP, and then also Slovenia and Hungary who stick out. Perhaps you know these numbers better than I do, but just to point out in terms of Slovakia and Hungary, this is primarily car exports or car parts, sometimes also tires. And Slovenia, this is basically dominated by pharmaceutical products, medicaments, etc. So you could argue that Slovakia and Hungary are the most exposed because it's dominated by one particular good, cars. And we know cars is an important topic for Trump. He always complains that Europeans are not buying US cars, they're not buying US foods. Those are some of his primary concerns. And so those 2 countries could face potential problems if Trump really focuses on cars. There was also some talk about car wars instead of just trade wars during his first presidency. So this could something that could come back to haunt European countries. But overall, I would say the threat for Central and Eastern Europe is not particularly large, at least in terms of goods trade. One more important point to note about the US, the deficit in goods trade remains very high. So we've had all these tariffs under the first Trump presidency. We've had some further tariffs on the Biden with the result you see here on the left-hand side, the result is basically nothing has changed. The deficit has even increased in absolute terms. And in terms of GDP, it has remained rather stable over the last 10 years, around 4%. So there has been a lot of shifts in terms of trade flows. And you see it on the right-hand side, dependence on China seems to have decreased. Share of goods imported from China has fallen from above 20% to around 13%. So things look good, so less dependence on China, you might say. But then if you look beneath the surface, you see dependence on Mexico has increased, dependence on Vietnam and India has increased. So part of that has just been relocation or avoiding tariffs by going through third-party countries such as Mexico and Vietnam and India, but also producing more. So Chinese companies producing more in Mexico and then exporting from Mexico to the US. So not an actual decrease of dependence on Chinese producers, but just a relocation of production and trade flows. But nonetheless, this is affecting global trade, and global trade has been growing less over the last few years than prior. You see that growth has been cut in half almost, or even more so. So we had this phase of hyperglobalization in the early 2000s with China joining the WTO, and then some rise of protectionism after global financial crisis, and then of course Trump presidency 1.0 and also Made in China 2025 program that's introduced to decrease dependence on the rest of the world, and lots of talk about tariffs and other trade restrictions. And so trade was growing at around 3% over the last few years, and this is also the forecast by the IMF. So the talk about deglobalization seems to be exaggerated, but as I mentioned, rearrangement of trade flows, more trade within neighboring friendly countries, less trade between the big blocks, US bloc and China, Russia bloc. So let's turn to Europe, where I would argue Europe is better than its reputation. But let's start with some facts that are not very encouraging indeed. So economic growth has been rather modest in Europe as a whole, and especially in the Eurozone. You see here the evolution of real GDP since 2019. Of course, with the big drop during the pandemic, and then at the beginning a rapid recovery, but this recovery has slowed down quite substantially. And what sticks out obviously is Germany, where the economy has the same size as it had in 2019, so no growth for the past 5 years. This is really a shocking news, so to say, but also little growth in France, in Italy. Spain sticks out with high growth, around 3% annualized growth. But even that is less than what Switzerland had over the same period. And Switzerland is not really known for a very dynamic, high growing economy. So it's striking that especially the larger European economies have had only very little growth over the last few years. So we know that, and we also know about the political gridlock in the two largest economies, Germany and France. They are responsible for almost 50% of the euro area economy. So it's troubling that politics basically negatively affect the economy. There's enough economic troubles and problems already, and politics is certainly not helping at the moment. So that's well known. What's perhaps less well known is part of the reason has to do with consumer behavior and consumer spending. And here we have a big difference in terms of behavior between the US and Europe. You see the household saving rate on the left-hand side, and you see that the household saving rate has always been structurally higher in Europe than in the US. Part of this is just statistical or methodological differences, but it's really just structural. European consumers are more cautious, more anxious on average, while as US consumer, they're always happy to spend, even if they don't have the money. They even increased consumer credit, consumer debt over the last few years, despite much higher interest rates. And you see here the difference. So savings rate was always higher in Europe. It has even been increasing above 15%, whereas in the US, the trend has even gone further down. So savings rate is very, very low right now. And in many cases, in many households, it's even negative. But if you put it in terms of private consumption on the right-hand side, the consumption is rising rapidly in the US. It's even above the pre-pandemic trend. So this is really surprising news that basically the pandemic didn't happen. You're even above the trend that you had above before the pandemic. Whereas in Europe, it's the exact opposite. So consumers, as I mentioned, very cautious, very anxious. Of course, Ukraine war playing a major role in terms of sentiment, in terms of concerns that people have. Also inflation, of course, negatively affecting wallets and spending. But it has to be more than that. It has to be more like a mental sentiment issue that Europe hasn't even managed to come back on this lower pre-pandemic trend. And here again, I think a lot of it has to do with Germany, the largest economy. And you see here some sentiment indicators, firms, household, financial analysts on the left-hand side, and they are really very, very pessimistic right now. In terms of financial analysts, this is the most pessimistic they've been over the past 30 years. And in terms of firms and households, its sentiment is as negative as it was during the financial crisis, 2008, 2009, during the pandemic, or during Germany's recession in 2002, 2003. But we don't have a recession in Germany, so it's really striking that the sentiment is so negative. But again, I think a lot has to do with political uncertainty, which you see on the right-hand side. So this is based on media, publications, news articles, etc. And you can see that policy uncertainty has really gone through the roof with the current traffic light coalition in Germany. And this obviously hasn't helped to help the economy to recover. But again, I'll put this into to perspective. I think it's more a crisis of confidence and sentiment. As I said, Ukraine plays a role, domestic politics plays a role, but the economic fundamentals are actually not that bad. And I'll provide 3 reasons for that. First of all, unemployment is at an all-time low. It hasn't been any lower in the European Union as well as in the Eurozone since the beginning of statistical records. Nominal wage growth is very high at above 4%, so higher than inflation, which means that household incomes are rising. And as a result, consumer spending should rise as well, which it really hasn't so far. But I think there's not much reason to expect that savings rate will continue to stay this very high like they currently are. And then also equity markets, if you look at the German equity market in particular, where all the large automobile, the car producers are included, and they've actually lost quite a lot of market cap. But nonetheless, the German equity market, the DAX, reached an all-time high in 2024, not once or twice, but 44 times. So both economic fundamentals and equity markets seem to have a fundamentally different view than what you read in the media or what you hear from politicians. And also when you look at the more structural factors, the innovation and competitiveness indicators, at least some of the smaller European countries, they hold top position. Germany is one of the few large economies where it's even in the top 10 in terms of innovation. So this is from 2024. So it's not like Germany has fallen off a cliff. Experts, including firms and CEOs, still seem to think that the German economy is rather innovative compared to other countries. So here again, although they're in the top 10, we don't have any Central and Eastern European countries. I would say that Europe is a lot better than its reputation. And turning to the labor market, just briefly, that I mentioned unemployment being very low. Also, there's still a lot of talk or concern about labor shortage or labor scarcity. You see the numbers here, they've come down a little bit, especially in the manufacturing sector. But this has more to do with the general difficult situation in the manufacturing sector. So lack of demand, lack of investment, and along with it, not really a need to employ a lot of new people because orders are still quite low. So some signs of relief there, at least temporarily, but still quite a lot of concern in services and construction sector. When we go to the details, you see that shortage of skilled workers remains a big concern in many countries, but we also see there's a lot of differences between Central and Eastern European countries. It's particularly Poland that sticks out, especially in the manufacturing sector. Generally, we can say in the manufacturing sector, labor scarcity is a big problem in CEE countries, whereas in the services sector, the picture is more mixed. You have some countries that are actually below the EU or the Euro area average, but the overall, shortage of skilled workers remains a topic. It will remain a topic in the next few years. I've mentioned this last year in my presentation, primarily due to demographic reasons, but also because of migration flows. And the result of that is that the wage growth remains very high in Central and Eastern Europe. So this picture is basically the same as last year. They still have double-digit wage growth rates. So this is in nominal terms, but it's also very high in real terms. And of course, a concern for companies because their costs keep rising quite rapidly. So let's turn to geopolitics just briefly before I finish. A new Cold War. I've presented this view or this view on the world last year, and so this is bipolar world that we're going into, or we're basically already in. Meaning that the world is falling apart into a democratic bloc led by the US and its allies, and the autocratic bloc led by China and Russia. And I've presented the list last year, focusing only on Central and Eastern European countries. Here we have a map of the world. So this is not our analysis. This is from Capital Economics, independent research provider. But you see that basically, there's a lot of blue in the Western Hemisphere, including Japan, Australia, and New Zealand. And there's a lot of red in Asia, but also Africa is basically fully covered by China and allied countries, or at least countries that tend to lean towards the China bloc. And very few undecided or neutral countries. Among the larger ones, it's Brazil, it's South Africa, and Indonesia. And there was some criticism last year about Serbia, which you can see here is still red, so tending to lean towards China, which is controversial, understand, because last year it was pointed out that the most important trading partner is obviously the EU. It's not China or Russia, which is true, of course. But the numbers or the data behind this chart there's a lot of data behind it. They were looking at public opinion. They were looking at trade flows, investment, military aid, military security alliances, actual politics, what the president says, what the parliament decides, development aid, border disputes and whatnot. And so this is what they came up with finally. But I think the story still holds. You can argue about individual countries, but I would say overall European countries are clearly in the US camp. If they have to decide between the US and China, they will they will choose the US side, obviously, but in terms of trade, of course, and especially Germany, where China is an important trade partner, they try to keep good relationships with both sides. But I will argue that this will be increasingly difficult in the future. So geopolitics, a lot of risks. I have a list here on the right-hand side. Due to time constraints, I will not go into details. Lots of potential conflicts that could also be relevant to financial markets. But I think now with Trump 2.0, the obvious question or the elephant in the room is, of course, what does happen in Ukraine? How does it continue? We have the Munich Security Conference this week, where apparently the US will present a proposal how to end the war in Ukraine. Apparently, Russia hasn't heard anything concrete yet from the US. So it will be interesting to see. Obviously, Trump didn't end the war in 24 hours like he claimed during the election campaign. So things are more difficult. But of course, that will be an issue that will remain very important in the coming months. I don't think there will be any easy solutions. And I think if there's any talk or even peace agreements, will likely be unsustainable or short-lived, as it has been in almost all cases where we had any agreements with Putin. So I'm more concerned that this will be a quick and Trump trying to get a quick win, and then not really concerned what happens afterwards. So this will be left over to Europe. And then we also have this discussion, of course, about what happens with NATO and NATO contributions with defense spending. You see here that as of last year, most countries are now in line with the 2% of GDP target, but Trump has already suggested 5% is the new target, which I think is completely unrealistic. There's very few countries that are actually at 5%. Russia and Israel are around that. Those numbers, you see Poland is very high at 4, going up even more this year. But for most countries, this seems highly unlikely to achieve, even if they wanted to, especially because we have so high levels of social expenditure that are, for obvious reasons, political reasons, are unlikely to be touched. And I also think tax increases are unlikely to happen at this scale. But yeah, here the upshot is we had a lot of increase of more than 10% last year for NATO member countries as a whole. So I think Europe, especially Western Europe, has woken up to this new reality, to this ongoing Russian threat. Perhaps as a final point, it's not only about China and Russia. I think it's also domestic disputes, the political turmoil, instability in many countries. I just mentioned a few here with the flags without going into the details. Obviously, US remains a very divided country. We had South Korea with president implementing martial law last year and then getting arrested as a result of it. And we've had mass protests in many countries, also Central and Eastern European countries for various reasons. Slovakia was one, Romania, Serbia. So you could argue, is democracy in danger not only from the outside, because the China and Russia bloc thinks these are democracy or Western countries are weak, they're undecisive, but also because they're divided domestically. So a lot of disagreements, instability. I'll leave this question open. I would still argue that democracy in the long run is the much better system that provides better economic results, better social results than autocratic systems. But yeah, in the short run, it's obviously easier if you have quick decisions by just one leader than if you have political parties who are in disagreement about a lot of issues. But let's conclude, so you still have time for questions and comments. These are my key takeaways. I think overall a gradual cyclical recovery is underway, also in Central and Eastern Europe. The good news, I think, is also that risks appear to be relatively balanced, which also has to do with the fact that there's so much negativity and pessimism, especially in Western Europe, which I think is unfounded. So there's room for positive surprises. And yeah, we have America first with Trump, which will have widespread consequences. But yeah, I mean, dogs that bark usually don't bite. And I think might also be the case with Trump, that things will not turn out to be as bad as many in Europe will fear. And I think the good news is also that I don't see any particular risks for Central and Eastern European countries in terms of Trump, in terms of trade, also in terms of security, because those countries have done their homework in terms of defense spending. They're well aware of the current situation with Russia, unlike some in the West. And so despite this bipolar world, I think there's still, as I mentioned at the beginning, some good reasons for cautious optimism, not only for 2025, but also beyond. So thanks for your attention, and I'm curious to hear what you have to say or ask about those views that I just presented. Thank you.
Okay, thank you, Martin. Just on time. We officially finished this, but of course now we have time for questions, so we are just on time. And it was very interesting. So if you have any question, you can write it to the chat or the F&A button. Now, I just have a question that I never basically. Now, how is the US actually financing this private spend? I mean, now you have a growth of an economy that is coming down, but on the other side, you have those guys that they are just increasing debt. I mean, private debt and public debt. So that is a bit I mean, I think that the whole debt situation globally is a major threat. So you didn't talk about that.
I didn't talk about that, but I completely agree with your assessment, and that's basically the simple or the short answer to the why the U.S. economy has outperformed. It's basically increase in debt, and it's both from households especially, but also from the public sector. I mean, government debt has gone through the roof over the last few years. The deficit is very high in the U.S. It was 7% of GDP. In Europe, we talk about going back to 3%, so a big difference. And yeah, I think this is completely unsustainable, even for the US. I mean, it's the global reserve currency, it's the largest economy, the largest military power, so they can afford high debt levels to some degree. But we also can't forget that interest rates remain very high in the US, and we have this deficit that is actually increasing, will continue to increase just because we have this basically debt or interest rate spiral in the US. So Trump should actually address this, and we have this new finance minister, Scott Bessent, who tries to get back to 3%. But can only say good luck with that, because with Trump's policies, it's more likely that the deficit will increase or at least stay very elevated. I mean, he wants to reduce taxes. Yeah. So even with higher tariffs, this is going nowhere. And so, yeah, I completely agree. This is a big concern. But as always with debt stories, we don't know where the limit is. Obviously, the sky is not the limit. At some point, bond investors will demand even higher interest rates, and US politics will have to address this issue. But I don't see this getting resolved anytime soon. So for now, it's a good reason for US economic outperformance. But in the medium to long term, this is a big concern. Yeah.
Mm. Yeah, I think it's too bad that in Europe we kind of lost this. I don't know, this mentality to work, which I think in Central Eastern Europe is so much more present because of the catch-up effect. Um, and that kind of like I was watching a German election show yesterday, and it's crazy what these guys are talking about. Having seen, those 4 years or 5 years of non-growth and what it made to I don't know, to the whole country, etc. But it's crazy. They don't even think about, hey, we should start working again. Creating the right impulse that people are incentivized to work, etc. It's really crazy. And the people were only clapping in the studio when the left talked. It was really funny when they said, yeah, blah, 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 everybody clapped. So it's crazy. And it's such a huge opportunity for Europe to step up now. But anyway, I'll let the floor to the questions because we have one, which is one was from Olga. She said a little bit broadly, she said uh, she would like to hear a little bit more about the Ukraine and Australia. Now, that is a bit of an open question. I ask her what she means. But Ukraine and Australia, what are your thoughts on those two countries?
Well, that is really a big difference between those two countries, and also not sure in what direction the question was going. I mean, Ukraine, I guess it's about the war. I try to point out a few things that I think that there's no easy or quick solutions. I mean, obviously, we all hope that this terrible war will end soon, but so far Russia has the upper hand on the battlefield, and I don't see that changing anytime soon. There's maybe some reason for hope in terms of what Trump has pointed out, that if things don't go the right way, namely towards an end of the war, that he will just increase pressure on Putin by increasing military support for the Ukraine. There's also now this talk about rare earths. So they have a deal with the Ukraine that Ukraine will export rare earths materials to the US and return, get more military and financial aid. So maybe this is one way of things moving in the right direction. But I don't see any reason for Russia to agree to any kind of peace talks or ceasefire. I don't see any reason why Putin would agree to that, because, as I said, he's making progress slowly but steadily on the battlefield, whereas Western Europe is getting weary, tired of this war. You mentioned it about the labor market. I think the same is true about the Ukraine war. People want this to be over with in the West and don't really both on the labor market and here in the UK more. I think many people still really haven't woken up to this new reality, and that the West actually needs to change its attitude, both in terms of what work means, but also what it means about what's going on in Ukraine and the implications for themselves. In terms of Australia, I'm not sure what what the question was there. Far away, I personally cover the Australian economy. Maybe in terms of what I mentioned about Trump, Australia is very little exposed against the US. Japan is a completely different issue, but Australia actually does very little trade with the US, and what it does is basically raw materials, commodities. Which the US needs. So I'm not concerned about Australia at all. It's more about Japan in the Pacific that is vulnerable to Trump. And for Australia, the focus still remains primarily China. I mean, this is by far the most important trading partner, it's more than 40%. But overall, the picture for Australia is quite similar to Europe. Australian economy has been in trouble for quite a while. I mean, it's always growing more rapidly than other advanced economies, also due to high immigration. But we still expect a slow recovery there as well from low levels. And next week, the first interest rate cut. So this is the only major country that hasn't cut interest rates yet, but we expect the first cut next week and then some more cuts over the course of the year.
Interesting. So we have a concrete question. That was a concrete question, actually. But how do you think the US will play the LNG card in the next future in relation to the EU?
Yeah, I mean, the LNG or energy export in general, but particularly energy, this has been like one topic or issue where there's some hope that the US and the EU will find common ground, namely if the EU imports more LNG, and they have a still high demand for LNG to substitute Russian gas, that if Europe imports more LNG from the US, that the European countries can avoid new additional tariffs in return, because this would obviously also reduce the trade deficit that the US has with European countries. So I think, yeah, this is one potential way that Europe could play, also that Trump could play. I mean, he has already hinted as much, that he will use this energy or LNG card to put Europe under pressure. But then again, LNG remains quite expensive, just because you have to transform it, liquefy it, transport it all across the Atlantic, transform it back again. You need those LNG terminals, which are still in short supply in Europe. And as I mentioned, it's just much more expensive than conventional gas, and obviously than gas was from Russia. And you also have US producers exporting LNG to Asia, so you're always competing with Asian countries for that LNG. But yeah, this might be one way to satisfy some of Trump's needs or demands, along with higher military spending. So yeah, why not try that to avoid tariffs? That would probably be a good idea for Europe, although it won't solve all energy or economic problems.
Crazy. Anyway, what about Greenland? How do you see that?
This is a crazy story. I mean, it's basically just as crazy as the talk about taking over Panama Canal and taking over Canada as the 51st state. I think it's just Trump talking, like he always sort of locker room talk or beer table talk. I don't think he's actually going through Greenland, occupy Greenland, withdrawing resources. I think here again he's probably interested in having some kind of deal. I mean, again, in terms of materials, geopolitical position, and it obviously makes sense what he says. So it's yeah, I can understand why he's interested in Greenland, but I mean, Greenland is obviously not up for sale, and yeah, I don't think he's gonna put any military troops there. That'd be crazy. I mean, his first term actually showed the opposite. He tries to withdraw US troops from all kinds of conflicts and from all around the world. U.S. generally is tired of being playing world police. So I don't think he's going to send any troops there. But yeah, as always, he probably wants to have some kind of deal with Greenland, and if it's in the interest of Greenland, I mean, they're trying to get independent, try to be less dependent on financial support from Denmark, and maybe this is one way for them to be financially independent if they can sell some of the resources to the U.S.
Crazy. Well, I think from also having lived in Asia for some time, and looking at what the China strategy is of securing, let's say, commodities across Africa, and you have shown that all of Africa is basically leaning towards the China,
Well, that's
and
scary, yeah.
and giving a bit also. And that is it's a clear strategy. That's a strategy, and Europe is not at all acting on this. And nobody in the Western press, at least in Switzerland or wherever, they really like what Trump is doing, and I'm also a little bit cautious probably, but because some of it is really crazy. But I think, in terms of securing commodities across the world and also finding allies in those countries, we need to do more in a different way. And anyway, that's just my opinion.
I
Now,
agree.
and I think we just are weak. There's this little joke when you say, what is the world's strongest foreign policy and the world's weakest, and the strongest is Russia, and the weakest is the EU. Because it's just, well, could also be China, of course. We talked about China, but it's so easy to act on one guy than finding an agreement. But anyway, it's not about me. There was one question, but it probably relates a little bit to this, and is now given this whole development and with Trump coming, the EU going to lean a little bit more towards China.
Whether this will happen, is that what the question
Yeah.
was?
Do you see the EU shifting slightly to China?
No, I don't think so. I think quite to the contrary. I think Europe will have an interest in satisfying at least some of Trump's demands, as I mentioned, in terms of defense spending. This is also justified, I think. I don't agree with Trump's methods, but in terms of opinion or content, he has a point there. And we've seen some tariffs that the EU was imposing actually on China last year on electric vehicles, 100% tariff on oh no, sorry, different tariffs on the Chinese electric vehicles and other things. So this is one indication that Europe is becoming less naive in terms of relationship with China. So US has always complained, well, they're stealing from us, they're cheating, they're supporting or subsidizing all their companies. And I think Europe slowly but steadily is waking up to this reality as well, and trying to find ways to have a level playing field, a more level playing field with China. And as I mentioned, China has a lot of structural and cyclical problems, and also with the geopolitical situation, I think it's rather unlikely that Europe will turn or lean towards China. I think quite the contrast, especially Germany. Probably put too much emphasis on China, also the car sector, which is a very large player. China, I think they're trying to get away or diversify away from them. And also what I presented last year, the report by the European Commission about critical or essential materials and resources, where they found out that more than 50% of those critical products came from China. I think this is also rather scary news, was rather scary news, and they're trying to diversify away from that as well. So I think it's rather the opposite. The EU, if at all, will rather lean more towards the US than to China.
Okay, super. Well, anyway, I would like to draw you once again to the picture that I've shown at the start, that we have very strong relationships between Switzerland and Western Europe, probably also with Central Eastern Europe. If you take the gross national products of the European countries together and its population, we are, stronger, and I say we as a Swiss, but we are stronger than the US. and we never look at it this way. I also think sometimes we completely underestimate what we could do, and I think we need to find this forward-looking spirit, which I think I see in the Central Eastern European countries. And I do hope that the spirit will go into kind of like growing Central Eastern European countries together with the rest of Europe, which they belong to, and that we also can confront the probably the major risk. We talked about the economy, but the major risk is the war, to me. And anyway, so to me, much is positive, and we are very happy that we have the Central Eastern European countries being part of us and being the growth engine in terms of economy of Europe. And so we're going to build on that. And well, that's it from my side, Martin. I talk too much. I'm not an economist. But anyway, I think these relationships are incredibly important. I thank you and Zürcher Kantonalbank for their long year standing partnership that we have. And I would like to close this webinar with a big thank you to you, Martin, and to everybody.
Thank you for having me. Thank you.
Okay, bye-bye. Have a good lunch.
Bye, everyone.